One thing that makes investing difficult is that it's always changing. So you can't just come up with a formula for investing and then just stay with it for the rest of your life. Sometimes we talk about this as investing over the life cycle or the investment life cycle. There are different stages that people move through as they get older. And here we start off with the growth-oriented youth investor, and they have ages 20 to 45, but those numbers can be tweaked a little bit. Okay, they're not set in stone. That's a pretty good number to start with for someone who's in a profession where they may have to retire younger because it's a physically demanding profession, perhaps a plumber or someone, or a carpenter, somebody who's doing physically demanding work may consider themselves to, be a growth-oriented investor only until they're 35 or 40. Okay, someone in my profession, such as a college professor, where we oftentimes work into our 80s, sometimes into our 90s, but oftentimes into our 70s, might want to stretch that out a bit and have us as a growth-oriented investor into our 50s and maybe even into our early 60s. Once you get to middle age, oftentimes you start thinking about consolidating your investment. And again, these numbers aren't set in stone. What do I mean by consolidation? I mean that you're going to be somewhat more conservative in your investments. Not conservative, but more conservative. So where when you were 20, you were happy to buy internet stocks and high-tech companies, and you didn't really care if the company, if some of those companies went bust, that was okay because some of the securities in your portfolio would do well and make up the difference. And you didn't mind if the price went up and down and up and down. In fact, the best thing that can happen to a really young investor is for the stock market to crash, because that means prices of securities are much, much cheaper. But once you get to middle age, you have other considerations. You're thinking about funding your child's college education. You're thinking about your retirement. And it's quite frightening if you're 10 years from retirement to see that your retirement portfolio has fallen in half. When you're 25 years old, it doesn't matter. Retirement's a long ways away. So in this case, what you'd like to do is add some somewhat more conservative securities to your portfolio. And then once you get to the income-oriented years, the retirement years, you'll choose an even more conservative portfolio where you'll be looking at companies that produce pay high dividends, or perhaps adding bonds and other types of things that kick off income to supplement your retirement. Okay, graphically it looks something like this. As you move through time, your wealth goes up. And you can see that in the growth-oriented years, it actually starts to accelerate. In fact, I probably should have drawn the line over here, or had the curve going up a little faster until about here. And then in consolidation, it starts to flatten out a little bit. Still going up, but it flattens out. It's not going up quite as steeply. Why? Because you're adding somewhat more conservative securities to your portfolio. Okay? A company like Microsoft back in the 80s and the early 90s was a growth-oriented company. Their stock price went up very rapidly. Why? Because they were a small company. Doubling their sales was rather easy to do. As they've become more conservative, they're more of a blue chip company now. So if you added blue chip stocks to your portfolio, you're still getting growth, but at a slower rate. These are not stocks that are going to double every few years because they're very, very big companies. Okay, it's hard for Microsoft to double its earnings. It's a big company. It's hard for General Electric to do that. That's a very, very big company. It's easier for a small company to do that. So you're still getting growth. Your wealth, and this is wealth on this axis, your wealth is going up, but it's going up at a slower rate. And then at some point, you reach retirement and you're living off this income and it starts to go down. And it goes down, why? Because while the portfolio may be growing, and it should be growing so that you can take more and more out each year to keep up with inflation, you're taking out more than you're putting in, than it's growing. Okay, you're probably not putting money into your accounts simply because you're retired. So your wealth goes up, and then it goes up at a slower rate, and then it starts to go down. And let's see if we can't sort of summarize these a little bit. In your early years, your growth-oriented years, you're looking for growth-oriented investments. Okay, stocks in small or medium-sized companies that have the potential to grow very rapidly. You get higher potential growth, but there's also much more risk. Okay, some of these companies will go bust. Their stock price sometimes shoots up very quickly and goes down very quickly. All right, you're more worried about capital gains, that is price appreciation. So when you buy a stock at 10 and it goes to 15, you have a $5 capital gain. You're not thinking about a dividend, which would be some sort of current income. So you're probably not investing a great deal in bonds. You're investing in growth-oriented stocks. Now you get to middle age, you have other concerns. Okay, you may be funding your child's education. You're starting to think about your retirement. Hopefully you've already been saving for your retirement. So you're moving to less risky investments to preserve capital. You still want growth, so you'd still want stocks in your portfolio, but you want blue chip stocks. You want a General Electric. Perhaps you want a Microsoft. Okay, Microsoft, even though you think of them as a tech company, it's basically a large blue chip company. Okay, they have very, very good income coming in. They're not going to grow very rapidly simply because they're such a big company. So you move to higher quality securities with lower risk. That is, ones that don't go up and down quite as much. Once you get to the retirement stage, you're really concerned about preserving your capital. That is, there's nothing more frightening than being 65 years old and saying, look, I have $1 million in my bank account, and that's going to fund my retirement, and the stock market crashes, and all of a sudden you have half that amount. So you're worried about preserving capital. You still want to have stocks in your portfolio because you still need some growth to keep up with inflation. Remember that even at a modest inflation rate of 3%, the price level is going to double in about 24 years. So if you think about that, you're 60 years old. By the time you're 84, $50,000 is only going to buy what $25,000 bought 24 years earlier. So it's important to keep up with inflation. And the reason you're moving to this more conservative portfolio as well is you need the income to supplement your retirement income. So if you're lucky enough to have a defined benefit pension, so a regular check coming in the mail from your employer, you may have some Social Security, but you're probably going to need some extra income. So what kinds of investments are appropriate for each stage? For growth-oriented common stocks, in fact, we should say what types of common stocks, perhaps for smaller companies, small company stocks, mid-sized companies. You may even want to delve into things like options and futures, which can be quite risky, but also quite rewarding. Middle age, you may want to move to lower risk growth and income stocks. Okay, a General Electric, a Microsoft, large companies that are quite stable, kick off some dividends. You may want to move to preferred stocks, high grade corporate bonds, or perhaps treasury bonds. And then when you get into your retirement or your income oriented years, you may want to move into lower risk income stocks that kick off good dividends, for perhaps utility stocks. Okay, the electric company, the water company tend to be pretty stable. People use electric, they use water consistently, and they tend to kick off a nice dividend. You may want to use mutual funds, which will allow you to diversify your portfolio nicely. But again, you have to pick the right mutual funds. There are mutual funds that invest in very risky securities. You may want to invest in government bonds, okay, high quality corporate bonds, that is investment grade corporate bonds, certificates of deposit, etc. But again, as you move through your life, your investment philosophy is going to change. And it's also the case if you're an investment advisor. You need to look at your clients, and as time goes on, you have to help them adjust their portfolio, and you don't do it all at once. It isn't like you hit 45 and all of a sudden you switch all of your securities. You just start adjusting the allocation. You start adjusting what they have in their portfolio. You don't do it all at once, but you start adjusting it slowly over time so that they have the appropriate mix of securities in their portfolio that's appropriate for their age and for their level of risk they're willing to tolerate.